The new government plans to spend more, but will that be enough to keep traditional industries intact and encourage new ones?
If we don't succeed in making sure we get more labor supply, we will just see a price increase.
Germany stands out as Europe's locomotive with its giant automotive brands, exemplary Mittelstand, SMEs, and strong exports. But what if you knew that this bright picture is overshadowed by rising public debt, demographic contraction, and energy costs? In 2025, German economic growth will be almost zero. For the first time, the government has revised its year-end growth forecast to no expansion. And even the first quarter of this year saw a recovery of only 0.2%. Although inflation seems to have eased, consumer prices will rise by 2.1% in 2025, while wage increases are lagging behind. Unemployment rose to 6.3% in April 2025, one of the highest levels in many years. Foreign trade is also showing signs of a crisis. Exports fell by 1.7% in the second half of 2024, reflecting losses in the Chinese and US markets. Energy costs are high, industrial production is weak, and the population is aging. Public spending is rising, leaving insufficient resources for private investment and innovation. In this video, I will discuss how Germany has lost its industrial giant status, the role of energy, demographics, and global competitiveness challenges, and what structural steps can revitalize the economy in the coming period. Your help motivates me a lot while making these videos. Don't forget to like the video and subscribe to the channel before watching the video. Germany's economy is no longer moving forward as strongly as before. In the last quarter of 2024, the economy shrank by 0.2%, and the recovery at the beginning of 2025 did not meet expectations either. So the engine is running, but the car is not accelerating even when the accelerator is pressed. Industrial production, the heart of the economic engine, jumped by a strong 3.0% month-on-month in March, but this recovery is far from making up for the previous sharp 1.3% slump. High energy costs, supply chain issues, and slowing global demand are still weighing on plants. Consumer confidence is at a 5-year low of negative 20.6, a slight improvement from March's negative 24.3, but not enough to revive spending. The public remains cautious in the shadow of inflation. The contraction in foreign demand also weighs heavily. In 2024, the total volume of exports fell by close to 1% compared to the previous year. Weakness in the Chinese and US markets is making even the Made in Germany brand less attractive. All these factors combined mean that the risk of recession is looming. Production is stagnant, spending is limited, and exports are slow. Unless energy costs come down and consumer confidence picks up, it seems difficult for Germany to break out of the recessionary cycle. Energy bills in Germany have reached such a point that industrial plants and families are experiencing bill shock. According to the 2024 average, the price of industrial electricity is 23 euro cents per kilowatt hour, 25% above the EU average, and the cost of natural gas is hovering around 34 euros per megawatt hour. These levels are almost 3 times higher than the long-term average 4 years ago. At the heart of this crisis is the collapse of the energy model based on long-term supplies of cheap gas from Russia. The Russia-Ukraine war that started in 2022 left Germany facing sudden supply disruptions. The country was immediately forced to make additional purchases of liquefied natural gas and on the spot market, passing the additional cost onto industry and consumers. Moreover, the renewable transition has been slow. While wind and solar installed capacity increased, storage and transmission infrastructure did not come online at the planned pace. Delayed permit-based plant approval processes and widespread objections from local communities delayed the commissioning of new plants. As a result, the cost base has risen. Without a full transition away from fossil fuels, and carbon fees are an additional burden. In the European emissions trading system, the cost per ton exceeds 80 euros. By paying this amount for every ton of CO2 emitted, producers are forced to raise the price of electricity, cement, and steel again. The consequences of these high costs are clear. Chemical giants, automotive supply industries, and steel mills are struggling to maintain their profit margins. Players like BASF and ThyssenKrupp are signaling to shift production capacity to Asia and the US. To make matters worse, households are also being forced to cut back on their consumption, with heating and electricity bills rising by more than 30%. In short, Germany is not only experiencing an energy crisis, but also a painful transformation of the energy model it has been building for years. Without lower energy costs and a strong renewal of infrastructure, both industry and domestic demand risk a sharp slowdown. Germany's industrial giants are now struggling with empty factories and full job vacancies. Current data shows that 28.3% of companies still cannot find enough qualified employees, MIFO. So what is causing this talent drought? First is demographic pressure. The 4.8 million baby boomers set to retire by 2035 will create a huge gap in the workforce. This wave of retirements combined with low birth rates weakens the supply of skilled workers. Secondly, lack of vocational training and transformation. According to the latest analysis of the Federal Employment Agency, there are serious unfilled positions in about 1/7 professions and in 183 business sectors, particularly in the fields of mechanical engineering, IT, healthcare, and teaching. The growing shortage is a reflection of the mismatch between the skills required by modern industry and the current education system. Third, immigration policy and integration challenges. Germany encourages immigration to strengthen its workforce, but complex bureaucracy and language barriers prevent qualified incoming workers from quickly joining the workforce. This delay can lead to potential newcomers withdrawing from the market before filling job vacancies. Fourth, the need for digital and green transformation. Industry 4.0 and energy transformation projects demand experts in robotics, artificial intelligence, and renewable energy. However, there are not enough certified training programs and rapid adaptation processes for these new skills. As a result, production is stalled, projects are disrupted, and cost pressures are rising. This is why Germany urgently needs to rethink its population structure as well as its education and immigration policies. Germany's export machine, which has been running like clockwork in recent years, suddenly seems to have stalled. In the second half of 2024, export volumes fell by 1.7% year-on-year. This means that even the Made in Germany hype is no longer the driver it once was. So why is this wheel not turning? First, protectionist policies and tariffs. Tariffs imposed by the US from all sides are making access to German products more difficult. According to a global survey, 39% of German exporters expect revenue losses in 2025, significantly higher than other major exporting countries. Second is the China factor, customer or competitor. Exports to China stagnated in 2024. What's more, China is taking market share from Germany in both automotive and machinery exports. Cheap labor and state-backed technology investments are leaving German brands behind in the race for price and innovation. Third, rising production costs. High energy bills and carbon prices are eroding coffers. These costs reduce the profitability of competitively priced export products. Unless neither energy nor raw material costs retreat, German plants will struggle to compete on price. Fourth, weaker global demand. Eurozone growth this year has been revised down to 0.9%. Germany's export earnings could fall by 2.2% in 2025. The slowdown in two major markets, China and the US, is reducing orders and fueling supply chain uncertainties. First, innovation and digitalization failure. Industry 4.0 projects have not been rolled out fast enough. The share of new technology exports is still low. Instead of high value-added products, Germany is losing competitive advantage in medium-tech products. These five factors are throwing Germany's export-led growth model out of kilter. To speed up the export machine again, it is essential to strengthen market access guarantees and invest in production and innovation. Germany set out with the ideal of a planned economy, but today it finds its biggest obstacle in its own bureaucratic mechanisms. Since 2020, the building permit process to build a new factory involves 9 steps and takes 100 to 26 days. This long wait infuriates investors and increases the cost of financing projects, but it's not just about time. Digital public services are still plagued by paper-based processes. Germany ranked 13th among EU member states in the 2022 DSI report. E-government and process automation are insufficient. Interagency system incompatibility leads to repeated reworking of applications, prolonging approval times. Then there are local objections. NIMBY attitudes can delay EIA processes for wind turbine or logistics facility projects by more than 8 months. As a result, investors turn to Poland or the Czech Republic for faster permits. The cost of bureaucracy is compounded by a lack of investment. In the fourth quarter of 2024, investment in machinery and equipment fell by 6.4%. Overall fixed capital investment as a share of GDP was also below the EU average of 22.2%. In Germany, it stands at around 20.4%. So, while waiting for authorization, the investment budget is being constrained. As a result, projects are blocked, jobs cannot be created, and technology investments are delayed. The combination of long permit times, lack of digitization, local objections, and insufficient investment budgets puts Germany at risk of losing its competitiveness. But all these data tell us this: Germany is no longer the Germany of old. The world's manufacturing giant has contracted for 2 years in a row, and even in 2025 it can only expect a recession. Yes, consumer spending will pick up a bit. Perhaps there will be a partial recovery in investment, but exports, Germany's strongest muscle at the heart of the economy, will remain under pressure for the 3rd year in a row. Tariffs, global uncertainty, and a contraction in major markets like China and the US are slowly eroding Germany's export-dependent industry, while things are not looking good at home. problem. The labor market is still tight, but an aging population and a shrinking labor supply pose a major long-term vulnerability. The budget deficit is high, government debt is rising, and social spending, especially on health and elderly care, is straining its sustainability. The direction of public spending is still unclear. There are promises for defense and infrastructure, but no details yet. Germany. The economic heart of Europe for decades. It is a country that everyone looks up to for its discipline, its production power, and its solid stance in crises. Even when the world collapsed in 2008, it survived. The Eurozone was plunged into crisis. Germany was the driving force. The pandemic came, supply chains were broken. Again, it was the fastest to recover, but the picture is different now. Today, there are noises coming from that perfectly functioning machine, and these noises are not to be taken lightly. Energy prices have soared, production has slowed, exports have lost their strength, and with an aging population, shrinking domestic demand, and a government with its hands tied, Germany is on the brink of a decision. It can either look to the future with courage and pursue digital transformation, energy independence, and next-generation investments, or it can cling to the success story of the past and become a giant that is slowly losing its influence. And this doesn't only concern Germany, because if Germany stumbles, Europe will stagger too. Your help motivates me a lot while making these videos. Don't forget to like the video and subscribe to the channel before watching the video.